Imagine walking away from your 9 to 5 at just 29 years old. No more alarm clocks, no more bosses, and just financial freedom. I know that might sound impossible, but today I am delighted to welcome Mustafa to the podcast and tell us how he got there, what he's doing now, and achieving that financial freedom. So welcome, Mustafa. Thank you. I'm very excited to have you on the show.
Hey Ahmad, thanks again for having me on the show. No, you're too kind.
No, I've been researching you this morning and we've been following each other on LinkedIn for a while. And I think you are very kind. You comment, you do give insights. So I'm very excited to learn. Let's go back on your journey. Let's start. How did you go into real estate? How did you find financial freedom? What were the early days of that?
Good question. I think for me, it was like a lot of stumbling and not necessarily looking for financial freedom. It wasn't really like a monetary goal. It was more of a, lifestyle type or, really goals oriented, but not monetary, if that makes sense. So for me, growing up, it was always emphasized that you need to be able to help people, and you need to figure out how to help people. And that, led me on a path to study genetics, to go to medical school. And then I was in medical school and it just didn't feel like the right fit for me. And growing up, I was from an entrepreneurial family, entrepreneurial background. So I knew that you didn't necessarily need to be a doctor to help people. So I decided to pivot. I decided that wasn't the right fit for me. And then I kind of wanted to figure out what the next steps were. I had a strong science background. I'm from New Jersey. New Jersey is like the pharmaceutical capital of the world, definitely of the US. So I found myself in the pharmaceutical industry, working in corporate America. And very early on, it was like, hey, yeah, I'm helping people in drug development and drug safety, making medication safe for people. That's awesome. But that's not really how I want to help people, or I want to help people on a larger scale and something more scalable. And, when I'm thinking about that, it felt like a very abstract goal to me. So it was really about like qualifying that and understanding what does that helping people actually mean. And for me, what I noticed is a lot of people, in my circles, they didn't really have financial literacy. And I didn't really know how to address that for them because everyone's background and exposure and access to things is different. So fundamentally, I went on this journey for myself to say, hey, how do you go from working a W-2 9 to 5 job, making your 40, 50, 60, 70, whatever your starting salary is out of college, to being in a position where you're financially free and you can just focus on giving charity if you want. You can focus on whatever your passion project is. So I went on that journey for myself. I created a couple of businesses. I exited them. And I found real estate was ultimately the most scalable for me, Ahmed. And the way I found real estate was by going to, the people who I knew to be the most successful and really understanding what their problem set is. Those people happened to be in real estate in my circle. Their problem set happened to be that they had access to a lot of amazing opportunities and not access to, let's say, enough capital. And it could be that you have a pipeline of 200 million and you have 100 million to deploy, or it could be that you had a pipeline of a million and 100,000 to deploy. Whatever the situation is, fundamentally it was, hey, this is the problem. And the way I address that is, hey, if there's a problem and I can build out a solution and I can create value, then eventually I'll be able to monetize off of that value I'm creating. And to me, that mindset and that approach is very repeatable for anybody. So whether you're working in that 9 to 5 job, you can go to your manager and you can see what his biggest problem is, take on that task. And then, on a quarterly basis, you talk about the good work they're doing and ask for a raise. Or if it's in the entrepreneurship game, it's to say, hey, how do I solve problems for customers and then charge them for that solution?
Let's go back a little bit because I think I don't want to brush over very, very important points that you just made. And I commend you enormously because you said it wasn't a monetary thing. It was more of a maybe personality. It was more a service oriented, but leaving your job, starting a business. Can you tell us a little bit about what the business was when you exited? And you said that people around your circle happen to have real estate. And then it's funny, those who have deal flow have less capital, and those who have capital sometimes lack deal flow. So let's start with your journey as an entrepreneur. So what made you different? What made you escape your 9 to 5 and say, okay, I need to start business? And then why did you exit it?
I think Ahmad, very simply what made me different is I think I take the time to like slow down and really break things down. Like you had another interview, recently that I was watching on YouTube, and it was about the gentleman who maybe at the age of 14, was able to win a Sega by really like, selling and hustling and really working the problem backwards. And like as a kid, I don't think we necessarily realize this in college or in life. I don't think we necessarily realize this. But like a lot of our goals feel insurmountable. But if you break them down into very small actionable steps and just put in the reps, everything becomes attainable. So for me, in that first job, that W-2 job, I'm fundamentally thinking, hey, I want to give charity, I want to help people, I want to give back. You can't really give back if you can't, put a roof over your head, or you can't make rent, or you can't make mortgage, or can't afford your car, or whatever. If you can't afford the basic cost of living, you can't necessarily give back. And then if you can afford the basic cost of living, but you want to give back in a way that you don't have to think about it, you need to have more money to be at that point in life. So for me, it was to say that fundamentally that American dream of working that 9 to 5 for the next 40 years doesn't necessarily make sense. The data doesn't necessarily support that because most people don't retire with enough money to live in retirement. The retirement numbers that most financial planners or most, providers are giving you is to say, hey, live on 60% or 80% of what you're making currently. Why would I want to make less in retirement? It makes no sense to me. I'm older. I have more experience. I should be able to figure out how to make more money as I go through life. So fundamentally, these are all the different things that I was thinking about to say, hey, I need to figure out a way to scale. And I think you touched on an interesting point about like the people who have deal flow don't have money and the people who have money don't have deal flow. I think it's very representative of us as people. Like we have our problem and we assume that everyone around us who is in a similar position has the same problem. But that's not really the case. If we treat our problem as, hey, this is my problem, but somebody else's skill set, then you're always networking and you're always looking out for the person who is uniquely qualified to solve my problem. And then it just comes down to like, okay, let's work out the terms to make it like a win-win for everybody. So I think, Ahmed, like looking at it today, that's kind of how I would look at it. Looking at it back then, it was very much like, hey, I need to optimize to learn and leverage that learning to optimize for salary. And I think that's advice I got, from a mentor of mine who was, my age, but maybe further along than I was at that point in time. And he was like basically saying that a lot of people in his circles, he was in the tech space. So a lot of them would move to California, get that high paying role instead of maybe starting their own company and being a founder. Being a founder is a grind and you're not necessarily going to make it, but you learn more. And then tomorrow you can leverage that learning for a higher paying salary in another, at that point it was like Google, Facebook, Meta, that type, Tesla, that type of company. But it's to say that if you spend your early years optimizing to learn and grow, then you're better positioned later in life to leverage that growth to make more money.
You're using a word that I love, which is leverage. I think leverage is one of the least understood concepts of life. Those who consume see leverage as bad. It's like they think leverage, credit card or debt or car payment or they don't see leverage as it's just not capital, it's experience, it's knowledge, it's connections. You can leverage so many things, and he who has the longest leverage or the biggest leverage always wins. That's the rule of life. And you mentioned something interesting too. You said you don't want to live at 40% of your salary or 60% of your salary, like most financial planners say, when you're 40 years of experience, 40 years of networking, 40 years in an industry. You should have depth. You should have a lot more saved up to get to the next levels. I don't think I definitely agree with you. And I want to touch on real estate more profoundly. Like, okay, you made this decision of starting your company and you reversed engineer. You said, and I had a similar experience. I had a startup that was doing well, 100% growth each year for 5 years. And then I still was not making money. And it was like a crazy realization. Like you also think, oh, you become an entrepreneur, you'll make money after 5 years. I was like, I have less money than when I started. This doesn't make sense. I'm selling double every year, yet I'm in a worse position financially. So I said, okay, what if I sell to the whole world? What if I get to that level where I sell to the whole world? Am I rich? And I noticed I wasn't. I wasn't going to be. So I said, okay, I need to pivot. I need to make something happen. And then that's when I decided to exit my company and go into real estate. So we definitely share the real estate side. Let's go into your real estate. Like, what was that first big deal? Why was it like your calling? Let's dive into that.
Yeah, sure. I think, Ahmed, there's so many different things that I would want to dive into on what you said. But let me first answer your question.
Thank you.
Fundamentally, from the way I look at things, these days everyone is saying follow your passion, find your calling, all of these things. And it all makes sense. It reads well as a LinkedIn post, a Twitter tweet, or an X, post, whatever it's called. But fundamentally, I think it's hard to know what you don't know. For a lot of people, we don't necessarily know what our passion or our calling is, but we know like what resonates. So looking at it today, I would say fundamentally, I like to solve problems. I like to feel like I'm helping people. So my strategy of going to the most successful people I know and saying, what is your problem? Looking at it today, I would say the most successful people are in a position where if you can solve their problems, they're willing to pay for that. They're in a position where they don't have time, but they have capital. So they're willing to allocate capital to save them time, meaning they're willing to pay people to do work for them. Now, Mustafa at 25, 27, 22, whatever it was, didn't necessarily understand those concepts, but it just happened to kind of resonate to have this approach. So ultimately for me, it was, hey, I did some research. I looked at it. He said, hey, he wants to raise capital. This was in about like 2017, 2018. So I structured a proposal to say that we should launch a crowdfunding platform. Imagine like Realty Mogul or Fundrise of that point in time. Now today the market is much more mature than it was almost 10 years ago now, probably about 8 years ago. So when I was looking at it about 8 years ago, every year the top 10 was drastically different. So there was not really much consistency in that market. So it's really to say, hey, how do you raise capital from people online with, nominal minimums, like let's say $1, $10, $100. So built out this whole budget, this whole proposal, etc. Now, mind you, I have like a genetic science background, so I have no formal, business background or no formal finance background. So anyway, so built out all of this, and I said, okay, it'll cost like $500K to build out this platform with, the goal of, let's say, raising $5 million in the first 3 years. I also tried to be, pretty conservative. Ultimately, the feedback was, yeah, this seems interesting, but that 4K has a huge opportunity cost. We could just invest that in real estate with much less risk rather than building out a platform, building out systems, spending money on marketing, etc. Like, okay, sounds good. Let's build out an MVP. Let's go more of a Reg D route and let's, see what that looks like. And so ultimately, that's what I did. The first project was, let's say, a short-term transaction where investors were projected to make 4.5% return in 3 months, so an 18% annualized return to investors. The way we structured the deal was that, we had equity and investors could come in and join us if they wanted to. So we had skin in the game. So it was basically, the way I built it out, Ahmad, was to really understand the people that I'm talking to. And like me at this point, I can look back at that and I can take a lot of different insights that I think are transferable for other people. For me, as somebody who raises capital professionally, it's much easier for me to talk to myself than for me to talk to someone else. So if I understand myself and I consistently talk to myself externally in a one-to-many type format, then I'm able to reach people who think like me. And I'm able to understand their concerns when they're analyzing a deal or an opportunity, or I'm able to analyze their situation and propose different potential solutions that might be real estate investment related, or that might be don't invest in real estate, go buy some books, hear the books, buy them, read them, come back to me, and we'll talk about next steps. Because, investing isn't the answer for everybody. And for me, Ahmad, the way I approach it, it's to really help the person where they're at and to really focus on optimizing for their growth. Because tomorrow, if they read the book and now it helps them grow their portfolio or grow their business or grow in their career, 5 years, 10 years from now, they'll look back and they said, hey, listen, I had a conversation with Mustafa, and that's what kickstarted my growth or my deciding to pivot and me figuring out how to actually monetize and make more money. And now I'm in a position to make money. Now I'm in a position to invest. And, Mustafa's projects may be good, may not be good, might not be the right fit, but let me at least reach out to him to see. And Ahmad, for me, that's been very scalable. And it's very contrary to a lot of the advice, guidance, or what I saw in the market in 2017, 18, 20. Nowadays, you see some of that, less of a like aggressive salesman type approach. But I think that analogy of like a used car salesman or just like, aggressive follow-up, it's not really me. I'm busy closing transactions. So I focus on working with people who want to invest, and I focus on really understanding their buy box. That way they get access to the deals and the opportunities that make sense to them. And then, every so often we'll peel back the curtain and we say, hey, you've been investing in this value add strategy. You have, 10 different projects with us. Ground up construction has more risk. It has more upside. Maybe it makes sense to layer that into the portfolio. So it's just about kind of the only way I feel like you can understand somebody is by actively listening to them when they're in front of you. But when they're not in front of you and you're kind of, trying to mentor people and help people, it's really to communicate in a way that's authentically you. That way all your conversations, resonate and jive. And when somebody shares their story, like how you shared your story, I'm like, that's awesome. Because that decision to pivot, you said it so calmly and so succinctly, but I'm sure when you were going through it, there were so many emotions attached to it. It's not fun to have to pivot or to realize that, you've put in all this work and it's not as scalable as you'd hoped. But then with that, when you're pivoting, you also realize, hey, I've done this for X amount of years. There is a lot of value that I've created here. I just need to figure out how to leverage that value in a more efficient manner. And I think a lot of people don't approach that realization that you approached or that you had or that I had. And sometimes it's just about somebody else coming and saying, hey, you're sitting on a gold mine. Just move, 2 inches to the left and dig, and you'll be fine.
I definitely, and there's a funny commonality that when I was 14 or 15, my dream was to study genetics. So you said something, and I didn't go into genetics because, I don't know, my entrepreneurial spirit was more, it was not so technical. I'm not a technical person. I'm an entrepreneur. I'm a visionary. I think ahead. And so I just wanted to just put that little parentheses in there. You said something very important about target audience, and a lot of people don't realize this. Your target audience should be the one that's able to pay. And it's as simple as that, but it's also as hard as that. A lot of people think, I want to do, like you said, a platform to get $1 investors. And $1 investors are not looking for you. They don't need you. They're not at that journey of their life where they say, I need to protect my wealth. They're more like Robin Hood investors where they're trying to do like fractional Tesla shares or fractional Apple shares or Nvidia shares and go on that roller coaster. And then you went on the Reg D route, which is interesting, and I just wanted to highlight what that is. It's just, accredited investments or accredited investors only syndication or funds where people can access real estate deals. And then you said something that I want to ask you about, your approach to finding and evaluating lucrative investment opportunities. Like what does that entail? Because if you have that capital flow and you have that network and you talk to yourself and you find people that are looking to invest, now how do you find the right deal?
Good questions. So I think let's start maybe with what you said first, where you basically alluded to the fact that you have to pivot to people who can like afford your services. This is something that really bothers me. And I don't know, I think it probably bothers you as well, just given your journey, because you come out as a visionary, like you want to help everyone. Then you realize that, hey, there's no money in this, or I can't help that person because in theory, they need money to invest. So it's like, okay, if I want to help that person, I need to focus on financial literacy. That's where I am. And I'm like, okay, I need to focus on financial literacy, but you also like need to pay your bills. You need to scale. You need to also grow. And those people that you're investing in mentoring them in terms of financial literacy, that's like a 5-10 year sales cycle, let's say. Your intention is to help them and help them grow and help them achieve financial security. But ultimately part of that is also like, potentially buying your service or, listening to this podcast or investing with me in real estate, etc. Right? To kind of help them on that journey if it makes sense and if it's the right fit for them. But if you just focused all your time on, if you or I just focus all of our time on that 10-year sales cycle, there would be no sale for 10 years. So there would be no revenue generated for 10 years. It doesn't make sense. So it's to say that fundamentally, the first part of the strategy or the first part of the approach for any entrepreneur is really, I think, a top-down approach with people who can afford your services, whatever they are. And to me, that's annoying because I like bottom up, I like grassroots, I like, democratized finance. That's really what I built my strategy on, at a very foundational level. So it's just to say, okay, I just need to accomplish 10 years of growth in 1 year. How do I do that? And it's just to be, hyper aggressive in terms of like my own approach to things and in terms of my own journey and my own scaling. And then say, hey, if I'm in a position where I can talk to most people and I can improve their finances in one conversation, then it's just about if they're listening and if they take action. That's no longer like a me problem. Like I did what I could. They opened up the conversation to say that they wanted to talk about money, which is typically, very taboo. So I present as like somebody who's, happy to listen. If you're buying a car, happy to talk about that. If you're buying a house, happy to talk about that. If you're looking at investments, happy to talk about that. I'm not necessarily looking to pitch my investment options or looking to have you, hire me as your financial advisor. I'm not a financial advisor. And I'm very happy to not be one. Just really happy to just be structured as like, a person you can talk to based on where you are in life. And even for my clients, it's the same. Like they're talking to me and they're mentioning that they changed jobs. So I'm like, okay, to me, that's a buy signal. Or like a light bulb turns on in my head to say, hey, they can invest with their retirement capital. And they probably don't know that because less than 2% of people have self-directed IRAs. So now they were working in this pharmaceutical company, in this tech company, in this IT company for 4 years. They probably contributed at least 10K a year. That's 40K. Their company probably matched dollar for dollar. That's another 40K. They have 80K sitting in a 401K with an opaque fee structure that they don't understand, with opaque asset allocation that most people don't understand. So let's sit down and talk about that if they want to. So it's very simply to say, okay, hey, what did you do with your old 401K? And most of them are like, yeah, Mustafa, I don't know. I'm like, okay, are you happy not knowing? Because like that's your money that you've invested for retirement that you're paying a lot in fees for, and the fees aren't really clearly communicated to you. So when the market grows 20% and your 401k grows 10%, that's suboptimal because your 401k is invested in the market. Where did that 10% go? Did you have the wrong asset allocation? Like what's going on? And it's to say, okay, now imagine you had suboptimal growth for 40 years, and that's the money that you're banking on for retirement. To some degree, that's why a self-directed IRA might be an interesting option. I'm not even saying invest in real estate. In this example, Ahmed, what I'm saying is just having more clarity on where your money is, which is hard for people, right? So I'm not really approaching this as a judgment thing. I'm approaching it as we're all spinning so many plates. We have our personal lives, our professional lives, the things we want to do for fun. Do we really want to sit down and treat money like a job? Say, hey, managing my money is my job. The reality is it is, but college isn't teaching you that. Your employer isn't teaching you that. So most people aren't looking at their money thinking, hey, managing money is a job. It's a skill set, and I need to actually learn how to manage money. So because of that, people's financial literacy isn't where it needs to be. And then ultimately at 65, when it's quote unquote too late or you have less time to actually make changes, that's when you kind of start to realize that, hey, there's a problem financially in my portfolio. And so for me, Ahmad, that's really what I try to have that conversation, but I try not to have it as quickly as we just did because everyone is kind of at a different phase in life. So we just want to peel back the layers and then over time kind of get somebody to feel comfortable. And along that way, we're talking about different investment strategies. I think this was one of your other questions. For a lot of people, investing in private placement stuff or alternative investments, the type of stuff we do, feels scary. Why does it feel scary? I don't have a one-size-fits-all answer, but I think fundamentally it's rooted in a lack of like knowledge, right? Just like, when you wake up, like if everything is dark, you're like a little disoriented. You turn on the lights, you know what's going on, and then you feel like, okay, I'm good. And I think that's kind of what personal finance is, investments are. A lot of people are fed the narrative that, you need to be diversified. But when they hear that, they think stock diversification. They don't think of diversification outside the equities market. So it's not really diversification if you were to talk to somebody like you or me. And for me, it's not really to aggressively challenge these assumptions. It's just to ask the question, are you happy where you are? Because if you're happy where you are, then that's perfectly fine. Then, keep doing what you're doing. If there's ways I can help you do better your strategy, more than happy to. But if you're not sure, or if you're happy and you're curious, or if you're unhappy, then more than happy to go into a deeper conversation to say what else is out there. Like for me, I'm of the opinion I have amazing strategies and, people have good performance, etc. We have a Reg A Tier 2 fund at this point. So we did launch one in the end. Last year, investors made 20% there. That was their return. The fund made even more, right? But ultimately, I'm always on the lookout for other opportunities that are better than what I'm structuring. Because if I find those, then I'm deploying my capital there. I'm not going to deploy my capital in my projects that are worse performing, because fundamentally it's about finding the best performing investment vehicles, because money is a tool and it's about growing that tool to accomplish whatever your goals are. For me, my goals are more philanthropic in nature, and I see it as like, hey, like beneath all of this, I'm a bleeding heart. So it's to say that I want to help people at scale. People need infrastructure, they need access to resources. There's a lot of needs, and we're in a situation where we're in the US. We have access to a lot of things that we take for granted. So how do you build on that, help people here, generate revenue here, and then create systems here, wherever you see need, and then really like scale that, whether it's, poverty in the US, or poverty internationally. Fundamentally, for me at least, the goal is to really help people, and real estate and all these things, and kind of creating that foundation for me and the clients I work with is a segue to helping people that maybe don't have the capital or the access to resources to help themselves.
That was a lot of very, very important points. I agree with you. I believe those who need it the most are those that don't understand it the least. And the entrepreneurial spirit of like, hey, if you have little capital, you should put it to work in the highest returning, most secure places. But there's incredibly high barrier to entries to these places. So companies like yours and mine help people access them. Yet I agree, it's scary when you don't have the knowledge. It's very scary when you don't have the right understanding or you don't have the experience. Like my investors are, a lot of them are doctors, extremely educated people making a lot of money. Yet I definitely have to handhold when I say, you commit capital to a fund, then the fund will call it. And they're like, what? I don't understand. Do you have the project or you not have, it's like, it's a whole journey that you have to go through them. And I launched a book this week to explain how fund investments are, because even myself, when I exited as an entrepreneur, and I was like, I had these questions and I wish I had someone to explain them to me. So I 100% agree that financial literacy is one of the most deficient in society, and those who need it the most understand it the least. I think that's a huge gap, and I commend you for trying to talk to them and help them, because I think that creates philanthropically the most impact. You also mentioned something about diversification that I want to touch on, which is incredibly important, because if you look at the data from 1996 to today, there's about 50% less publicly traded stocks in the world. Since 1996 to today, everything has become correlated. Correlation means when something goes up, the other thing goes up as well. Let's say if stocks go up, bonds go up. If stocks go down, bonds go down. And crypto and international stocks and tech and energy stocks, like things that used to not be correlated now are very correlated. So when people hear diversification, they're in the same pot. If you are correlated, it's the same thing. It's really no diversification. So what in your opinion makes real estate the ultimate wealth protector and generator? What do you see in real estate that people should know? And what's your approach to say, like, this is safe and what is not safe?
But I think you touched on a lot of great points, and I appreciate that. And I think your question is really apt as well, because real estate is traditionally viewed as like the safest asset class to get into. And I think on your YouTube channel, you mentioned like the value and the importance of like US real estate. So the US as a country where we both live is nicely positioned, let's say, in a very good position, in a very secure position where it's viewed very highly. But the reality is all investments carry risk. So it's important to say that, hey, just because we might view the US highly or real estate highly does not mean every market in the US is the same. And it does not mean that every strategy within real estate is the same. Just like every stock, although there are less of them today than in 1960s, not every stock is the same, right? So I think first and foremost, what attracts me to real estate is I think the fact that you can sit down and you can actually fundamentally understand the numbers. When you're reading the prospectus of a stock or when you're analyzing the balance sheet of a stock, I think the numbers are more complex. And to understand how those numbers are reflected in the stock price is even more complex. So I think to some degree, the ability to dissect and understand what you're investing in and how to drive value creation is valuable. Like we could look at the example of Meta, Facebook. Facebook recently changed its name, let's say in the last year or so, to Meta, with like the intention that they're going heavy in the metaverse. Before that, Facebook was viewed as, let's say, like a social media platform. When Facebook launched, what were they selling? They're selling the ability to connect to other college kids. There was no clear monetization strategy. The stock market didn't necessarily view Facebook highly at that point in time, or the Facebook, because they dropped the pretty early on. But ultimately, they're able to build out that platform or that gold mine, and then they moved to the left a little bit, and then they dug and they monetized by, creating ad revenue and by positioning and monetizing off of their marketing services. So I think, when I look at real estate, and I'm just using that as an example because their journey, they were able to keep their company and pivot and monetize, or maybe you and I had to pivot and figure out a different way to monetize. Right? So every entrepreneur's journey is a bit different. But for every investor, I think when you're investing, like that example you gave of physicians, right? I have plenty of physicians who don't know how to deposit a check or send a wire, or the fact that you can deposit your bank account's check at somebody else's bank account, right? So if you have TD Bank, you can go to Chase and deposit your TD Bank check. People don't know that. And to some people, that might be very basic. But on the flip side, your doctor might be talking about like your carotid artery, and you and I might not know where that is or how important that is, right? So I think, if you spent X amount of years becoming an expert in your space, people will view that as you're an expert in every space, right? So some people will come to me and they'll talk to me about things outside of my area of expertise, and I'll answer them and I'll say, this is outside of my area of expertise, so talk to somebody else as well. A normal example would be like tax questions. You probably get that all the time. How am I taxed? And you're like, hey, this is your answer, but talk to your CPA. And you're saying talk to your CPA not as like a cop-out, but to say, hey, like I'm like 99% right, but your tax situation might be the 1% difference, right? So similarly, I think for that physician, we might view it as, hey, he's highly educated, or the lawyer, the engineer, whatever it is, they're highly educated, they should know how to manage their money. But to your point, I think those are the people that sometimes need help the most because they spent all of their time getting very specialized in one avenue and didn't spend any time or that much time really focusing on their personal finances. So it's like there's a knowledge gap, but psychologically, because we view them as good in one thing, we view them as good in everything. And these are the types of things that you start learning, like when you read different books, to kind of open your mind on what else is out there. But kind of circling back to real estate, I think real estate has proven historically to be a very strong asset class and to be a good hedge against inflation. Now we're in a situation post-COVID where inflation was very high, and now inflation seems to be a bit more manageable, with the Fed targeting 2 to 3% and we being at a little above 3%. But fundamentally, I think when I look at real estate, I think what's happened, pre-COVID, the nation was changing to a renter nation, which is maybe more similar in Europe. Post-COVID, that has happened much faster, where people can't afford to buy houses. I was reading over the weekend that, the home ownership affordability index is at like an all-time low. So it has never been this expensive for people to buy houses. First, in comparison to their income, which to me makes sense. Like when I look at the average income, when I look at the average house, I live in New Jersey. New Jersey is a pretty expensive state to live in. I don't really do my grocery shopping or anything, but when I do, I'm like, wow, this stuff is expensive. I go to buy a chocolate bar, it's like $2.50. It used to be like $1. Now for me, it's a nominal thing, but as a percentage, it's interesting and educational. Imagine if everything was 2x higher. Things would be more expensive. I drive an electric car. I don't really track gas prices. When I drive my wife's car, I'm like, oh, gas is cheaper, gas is more expensive, whatever it is. So I think, circling back to real estate, fundamentally, people need somewhere to live. So then the question is, where are they living? If they can't afford to buy because buying got more expensive in terms of sale prices and appraised values, and then you add on interest rates, which went on it went up a lot, right? So now your cost of financing is much more expensive. So what does that mean? If I want to sell my house, yeah, I can sell my house and I can buy another house. But from a financial position, selling my house probably put me back like 5-10 years. The average person, I would say probably 10 years in terms of as a financial decision. For most people, if you bought your house pre-COVID, buy that other house, but put your current house on rent. Just because you have low interest rate debt, right? You have like a 3% interest rate. You're not getting that type of interest rate probably in our lifetimes, right? If inflation is pegged to be 2 to 3%, that means that your borrowing cost is effectively zero after inflation, maybe 1% after inflation. So why would you sell and give up that low interest rate loan? So to me, like, there's so many different layers that make real estate so secure. And then fundamentally for us, we invest in New Jersey, 30 to 45 minutes from New York City. We invest in opportunity zones. So there are tax abatements at the asset level, right? So now you have lower property tax, where let's say you're building a $5 million building and you're paying maybe $3,000 a year in property taxes. That's huge. That saves your expense. That means your net operating income is higher. That means your asset appraises for more. So there's a couple different ways, Ahmed, that I would address that question. But I think fundamentally it comes down to the real estate strategy and what are you investing in. Like recently, there was an article that I saw that talked about office spaces and how the office sector has resumed to pre-pandemic levels. What that means is like everyone left the cities in the pandemic. Now everyone's back in the cities working. So now if I was an office investor and I was like an opportunistic investor, basically like I'm looking for like the best opportunities, it indirectly means that you're taking on a lot of risk, I would say. I would have invested in office when everyone is leaving the market. And this is like a very Warren Buffett type approach. Like, when things are good, you take money off the table. When things are bad, you put money in and you invest. But all of that kind of circles back to like the investor, the person you're talking to, and what their ethos is on money, and to kind of peel back those layers to say, hey, if they're not comfortable investing in real estate, we start with a highly liquid strategy with a short term. And then as they see proof of concept, they get more comfortable. Just like if I've never invested in any stock, the first step is to download Robinhood or get a Fidelity account or whatever brokerage, and to start investing with a small amount to kind of build up that comfort level. And it's true of anything. Like you don't just go and become a doctor one day. You go, at least in the US, you go for undergraduate, then you take your MCAT, then you apply for medical school, then you do medical school, and then you become a doctor, right? So there are stages. And I think for investing, there are also stages, but it's not as rigorously documented as maybe how we would document our education process.
I definitely want to go into the mindset side, because I think this graduation, or what you're saying about journey into becoming a better investor, is changing mindsets. It's different experience gives you a different mindset to tackle different challenges and different opportunities. What you said about housing is incredibly interesting. I have been doing some research on the supply demand imbalance that exists in housing in the US, and it's 6 million units. The US only builds about 400 to 500,000 per year. At that rate, it takes 20 years to fix that supply-demand imbalance. So that's like economics 101. Like how do you find a market that has safety is when you have a heightened demand and the supply is limited. So 100% agree with you there. And then you added the layer of what's going on right now. Right now, we do live in a higher interest rate environment. We went from the lowest interest rate environment to a normal interest rate environment, but never as fast as that ever in history. So that is putting so much pressure into the assets themselves that some will survive and some will not survive. So I thought your comment of not two investments are created equal is very, very interesting and real. And that's why you need to work with experienced allocators, with experienced operators, people that have gone through certain things, because if you want to be an investor yourself, it might be scary to look at a offering memo, but it's much scarier doing it yourself. I think doctors, high net worth individuals, high earners are sometimes quick to buy that second house, sometimes quick to invest into an Airbnb strategy, thinking that at least I have the asset, at least I have, I can, my salary can cover the mortgage. So worst case scenario, I can keep this. But I would argue that it's going that route is scarier because you don't have the pulse of what's going on. It's the same thing as saying, I need to operate on my heart because I read this thing that's really interesting, or and I think I can fix it. Worst case scenario, it's still my heart. Like trying to like be a little bit obnoxious with my example, but that's how I feel when people think, oh, I'm not gonna, why would I go with you when I can flip a property in Florida? I'm just gonna fix it and then I'm gonna sell it for double what I bought. I'm like, yeah, good luck.
And I think that there's a couple things, Ahmed, that ring true for me in that situation. And some of these things, like, I hate to admit, or like I fight this belief when I learn about it. Right. So the first one is that people are emotional in nature. So we make decisions emotionally and we justify it with logic. This is something that like I'm at odds with to agree and to buy into. So what I do is I keep that as one side. Like, hey, people approach things like this. So if I'm to agree with that sentiment and that belief, the reason why that person is going to buy a second house or buy an Airbnb is because that's on trend. So when I'm talking to that person, I'm going to say, hey, listen, and I had a call like this yesterday. Guy, works in AWS for Amazon, smart guy, and his wife is saying, hey, let's buy a second house. I'm like, okay, cool. So talk to me about your first house. Bought pre-pandemic. Okay. Are you going to sell? No, we're going to put it on rent. Okay, cool. Are you going to buy a new house? Okay, cool. In Texas, great. So he's giving me his buy box and I'm saying, okay, if you want to do this, this is how I would do it. I would buy the ugliest house in the nicest neighborhood and I would make it look nicer, renovate. At least then you have positive equity. You've created value. Or if you want ground up construction, I'd find a developer in the area and I would find a way to add value to him, invest in his other projects and get him to build as close to cost as for you. Because what can happen is sometimes people are saying something based on their experience. If you're in a market like Texas, there's so much land. It's unbelievable. And there's so much development or investment going on. But when you look at like the institutional data, the CoStars, the Yardies, they're saying that these Sunbelt markets are overbuilt. So what does that mean for you as an investor? Everyone and their mother is talking about investing in this market, and you're joining the party because that's where the hype is. Typically, if everyone is talking about an investment opportunity, it is not a good investment opportunity because it's too late to the game.
I 100% agree with you. I think when someone is you have to, when everybody zigs, you have to zag. You have to go the opposite. And this is something that is not intuitive. And I 100% agree with you. I would argue actually that not only is it overbuilt, is that if you have an affordability crisis on ownership, I think you have an affordability crisis on rentability. That's why I'm a little bit more skeptical on residential. What do you think?
I think it's a great point. And that's why you got to go at like renter by necessity category, because that market has only ever been able to rent. So like for us, right, we build new construction. We target renter by necessity category people, like your blue collar workers. So fundamentally, those blue collar jobs, they're the backbone of the economy. When those people are being laid off at scale, there are bigger issues in the economy than real estate. Right? If your nurses are getting fired at scale, your bus drivers, your teachers, there's bigger issues in the economy. So that's kind of how I position it to say, hey, listen, when my white collar jobs who did very well in COVID, but then were, cut back, like especially those tech jobs, they were cut back pretty aggressively. The tech jobs, the pharmaceutical jobs in the last, 2 years or so, they've seen a lot of layoffs. That's your like upper band, your, let's say, class A type tenants. we don't really build for that category, right? We build for workforce housing, the people who have historically only ever been able to rent. And then we also build and structure it so that we're cheaper than our surrounding markets. So now if somebody wants to rent and they're looking at it, they can pay $300 to $500 more per unit per month, or they can rent with us. So also, like, with respect to affordability, it's also positioning yourself in the right place in the market to have a high quality product at a more affordable price. Then you just keep demand sky high, which is, I think, something you alluded to as well when you talked about construction, when you talked about the housing crisis. For us, we're in the most densely populated state outside the largest metropolitan area, under the busiest airspace between, Newark, LaGuardia, JFK. So there's a lot going for us in terms of demand. And New Jersey is a very, very small state. So from a population density perspective, it's the most densely populated. So I think that's why, like, the positioning is right, is important rather. But I would agree with what you said about affordability and rent. And I think you see that also in occupancy rates across the nation, where, like, in some markets like New Jersey, they're holding pretty high. But in some markets in the Sun Belt, that's not necessarily the case because, for us, like, we have operational efficiency. We've been in that market for years. But if I'm a syndicator who's doing one project in North Carolina, one project in South Carolina, one project in Florida, one project in Texas, I don't necessarily have one team or that infrastructure built in to really have operational efficiency in that one market. And so that can pose as a challenge to me. So I think for any, institutional type investor, I think it's also about finding best in class in each region. Just like today in that doctor example, I would go to my general physician, my primary care physician, and they'd say, hey, you have a heart problem, go to the cardiologist. They're not trying to solve that heart problem themselves, even though they also went to med school, because their residency, their specialized training was in something else. So I think for you and I as well, it's to say, hey, if we want multifamily, find the best people in multifamily. If we want retail, find the best people in retail. Or office, find the best people in office. Cold storage or storage, find the best people in that. So I think that's really how I would approach it. And looking at that fundamental analysis to say, hey, why would somebody, in my case in multifamily, why would somebody, choose to rent here? And in your case, I think you do a lot of like strip malls or anchor stores, if I understand correctly. So it's to say, hey, fundamentally, what does like the population look like in this area? What are their average incomes? What are they typically, find commuting to in terms of store? What is the traffic flow? Like, how many cars are passing this location each day, each month? So that type of data, which I wouldn't look at in multifamily, right? It's very different. But now the challenge is, like, we went from institutional type investor to, let's say, a fund manager type investor to retail type investor. That retail investor doesn't necessarily know to think about this, right? Like, how many times do you get asked, like, how many people drive across this site? But it's probably something that you look at, right? And it's something that...
For sure. Yeah, I love and you were very eloquent in saying, using the doctor example of how approaching real estate. And this is exactly our thesis at Infinity. We're not a sponsor, we're an allocator. An allocation means, how do I put money to work with best-in-class sponsors that know what they're doing? Like, I don't have to tell, when we work with Whole Foods, for instance, we don't tell Whole Foods where to put their stores. They tell us where to put the store, where they want the stores, because they have a greater knowledge, greater due diligence, and that is leverage. What we were talking at the beginning, lever their insights. Amazon has the best insights, more than CoStar, more than Yardi. They know where they want to grow, how they want to grow, where's the demand going. So we don't tell them what to do. They tell us where they want their stores. The flip side is, how do we find the right developer with the right cost structure, with the right efficiencies, which is something that you just mentioned, to be able to say, this is the guy. I don't want a guy that has random stuff. I think very important point to make, like, work with a specialized, and the same thing with you doing medicine. You work the cardiologist, not the general doctor. Let's go to the mindset, which I don't want to skip over, because I think what you know is something important and valuable, which is, what is the one mindset shift that separates those financially free people from those that are stuck still in the rat race?
That is a very hard question. It's a very deep question. Yeah. In the sense that I don't think it's a one size fits all. So I can maybe just tell you what helped me. What's helped me is the idea that I don't know what I don't know. Like, from a young age, this really manifested as, like, why make a mistake It's better to listen to other people's mistakes and learn from them than make that mistake myself. But that's like a very like humbling mentality to adopt, let's say as a kid, where you're just like, hey, I'm not going to touch like a stove because this person said to, and I'm just going to blindly follow their advice. That mindset as a kid can only take you so far, because then you start at a certain point, you have to transition and you have to change the way you think, which is important in financial freedom. And it's important in, escaping that rat race, consistently questioning assumptions and standard practices that you have to get you to that next stage. Because what got you from $100 to $1,000 to 10,000 to 100,000 to 1,000,000 to 10 million to 100 million, there's growth. And part of growth means being uncomfortable constantly and putting in the work to grow and change. So you have to be comfortable being uncomfortable. As a kid, that meant, let's say, just blindly accepting what people tell you. Don't touch a stove, for example. You touch a stove, you get burned, you put toothpaste on your finger or whatever, and you move on in life. You don't do it again. But it would be so much better to not have been injured. But you can't always learn. You can learn the theory, but you can't feel the emotions and the experience without making those mistakes and those setbacks. Which is why at a certain point, when you have that foundation, you need to start taking risks. So with that mentality of you don't know what you don't know, let's say you have that first job and you can make ends meet and you have, some extra money left over, and everyone is saying to invest in the stock market because that's like conventional wisdom. What I would say is, like, at any point, if it's a question of investing in yourself versus investing in somebody else's product or whatever, I think investing in yourself is the better investment. Right? So it's like, hey, I want to invest in the stock market. I'm not going to spend $10 on Tesla stock. I'm going to buy a book about investing in the stock market, or buy an Audible because I don't like to read. So if you have a problem, there's a solution. You don't like to read, you can listen. You can buy an online ebook. So that's also part of this, is to say, really approaching that by saying, if I don't know what I don't know, I need to figure out how to understand where my blind spots are and keep an open mind, even when somebody is saying something I vehemently disagree with. Like a lot of things we said on the call today, we agree with. We agree with each other. There wasn't really areas of conflict, right? Like you said, I don't invest in multifamily. I didn't get emotionally upset about it. So that makes sense. And we transitioned to talk about commercial and what I understand you to invest in. And then you further clarified that, yes, I do exactly what you said, Mustafa, which I didn't know. And that's awesome for your clients to hear as well. But fundamentally, even if we had those disagreements, I'm of the mindset that we would both approach it like, hey, this is interesting. Let's hear out the other person and let's hear his thesis to see if it resonates with me, because he could be right, he could be wrong, and there's room to learn and grow. And I think fundamentally, for anybody who's on this journey to get financial freedom, I think it's important to understand that financial freedom is abnormal. Most people are not financially stable or financially free. And those are different levels. So if you want something abnormal, you have to do abnormal things. Part of doing abnormal things is approaching your life with a bit more intentionality. To say, hey, I'm making $50K a year right now. It'll take me 10 years to have $500K saved. It'll take me 100 years to have 5 million saved. I need 3 to 5 million to be financially free, or to be able to retire at 65. Now, you can work that number backwards to conclude why I'm saying that number versus the average person, which would tell you like 1 million. But I'm saying, hey, in retirement at 65, you need at least 150 a year. And you don't know how long you're going to live, and your healthcare expenses are going to be much larger. So for me, I think fundamentally, to answer your question, it's really been a mentality of, I don't know what I don't know. So how am I going to learn that? And that means doing things that don't always make sense or that are contrary. Like for me, I operate on an MVP model, minimum viable product, spending as little as possible. That got me to where I am today. Now, today I don't have free time. So I have to allocate money to leverage other people's time, to hire people, to build teams, things like that. But I'm frugal by nature. That's what got me here. Minimum viable product by nature. That's what got me here. So now I have to pay people, let's say, an obscene amount of money to see if they can deliver. And if they can't deliver, then I iterate and I pivot. Now, making those changes and making that pivot and recognizing that this is, let's say, a weakness or a reality of my situation is not easy, because no one's telling you that, because no one knows that except me. And I talk about it on a podcast, so now people know. But for me, talking about it is actually like a good thing, because it's a reminder to myself, and it's a reinforcement of why I invest in certain strategies. Like when I'm hiring people and I'm building teams, that's an extension of me investing in myself. And investing in myself has proven to be the best ROI and the most scalable investment I can make, because even when I lose money and I would have preferred to just on fire and burn it, there was like a learning and an educational aspect to that I can then take on that next experience when I'm hiring that next person or that next team to say, hey, how do I do it better to continue to aggressively scale? And I hope that answers your question, Ahmad.
Not only does it answer my question, I agree and I want to highlight something you said before that's been resonating in my mind is you have more of a scientific mindset of searching for truth mindset of saying, I don't know everything mindset of saying, I want to see your deal flow. I want to hear what you're doing because if it's better, I'll do it. This is what we're seeking. So I share that mindset with you. And I agree. When I decided to leverage other people's knowledge, I grew instead of trying to learn everything myself, instead of trying to do it everything myself. My hands itch because I'm an entrepreneur to get roll up my sleeves and get dirty and buy the ugliest property and do it myself. But then I'm like, well, if I know Mustafa in New Jersey, he has the best cost structure. He knows the banks. He knows the brokers. He knows the GC. He knows what the hell am I doing? I just work with him.
Yeah, and the thing is, part of that is like, conventional wisdom subconsciously tells us that we need to do everything ourselves. That's what we're taught at school. Teamwork,
linear thinking.
You're cheating, right? So to me, it's like part of this, I don't know what I don't know, is to go out and drop 100K or 50K or 50K on that project and do it myself. And then that's like, it's a pain in the butt in my portfolio where I'm just like, honestly, I don't have the time to go and resolve this. If I go and I do it, it will be profitable, etc. But it's not worth the opportunity cost of the other things that I'm doing. So I'll deal with that later when I have like free time, or I'll hire a person, I'll train them on how to deal with that, underperforming asset. But it's also to say, how do you educate somebody who doesn't have your same exact experience, that doctor, engineer, lawyer, whoever it is, to say fundamentally it's not worth your time. You have to talk about opportunity cost. You have to talk about the value of their time, but you have to talk about it in a way that resonates with them. And what might resonate with them is the fact that they're probably handcuffed to their job with golden handcuffs. They probably don't have free time to spend with their family. They would like free time to spend with their family. They look at you or I and think real estate is that answer, that they should become us. But we're not that doctor, engineer, lawyer. We don't have their specialized skill set. For us to drop everything and become them, or for them to do the opposite, is not strategic, because they'd spend maybe 10 years getting to the point where you or I are at. It's a waste of the many years they spent getting to where they already are.
Correct. And I think knowledge is just one part. I think more importantly is who you know and who knows you. Because if you are the guy in New Jersey, they will call you. They'll be like, Mustafa, hey, I have a deal. Don't never call the doctor. Don't never call that's not how this works. So even if it takes you 10 years to learn, to gain the skill set, it doesn't mean that you have the network already or the trust built in. It'll take you another 10 years. I take away a big takeaway from this podcast is work with specialized people, and then you can leverage that to get to your financial freedom. You don't have to, there's no reason to learn the formulas. There's no reason to become a technical at 3 things. There's just, how do I become better at what I do? How are you progressing at what you do, so that we can both add 1 + 1 is 3.
I think that's the thing. Like when you look at family offices, institutions, the people worth, let's say 100 million plus, they have the area they made their money, they have their diversification strategy, and they have their passion project. So they're only investing in 3 things, let's say. Meanwhile, if you look at the retail investor, the guy worth maybe up to 25 million, they're looking at 7 streams of income, because that's what trends in that circle. But what it is to say is that if you focus on one area as offense, what you're specialized in, where you make money, you focus on one area as defense, typically people do real estate, where you protect your wealth, and you focus on one area that's like your passion project, where you have fun, invest in car startups, or, educate people in Africa, or feed people in India, or wherever it is, right? That's typically how they break down their capital and their structure. And then to me, it's all educational, like you mentioned, right? I approach it as a very knowledge intensive approach to just say, hey, what's the most efficient strategy? Because really, you don't have to reinvent the wheel. We're taught that we need to make money, but really it's much simpler than that. Fundamentally, people have been owning real estate for hundreds of thousands of years and monetizing off of that, right? It's fundamentally, nothing's changed. It's all real estate, but it's just the way we monetize is different versus maybe 100 years ago or 1,000 years ago. But it's all the same. People were fighting over land back then. They're going to continue fighting about land today. Nothing's really changed.
Exactly. It's just a lot more sophisticated. And as it's like medicine, people too were curing people 1,000 years ago. Today, we are more sophisticated. You can't expect to know everything. Mustafa, it was a real pleasure talking to you. I really look forward to keeping in touch. And for those who listened, how can they get in touch with you?
I think the best way would probably be in the show notes. My LinkedIn information should be there. They can connect with me and then we can continue the conversation there.
Yeah, and I will continue the conversation offline because I think what you're doing is very interesting, and let's keep sharing, let's keep progressing and learning from each other. So thank you again for being on. It was a real pleasure.
No problem. Have a great day, guys.